Hello everyone, and welcome back to the channel. In today's video, we will discuss gold investment as a strategic tool for protecting wealth and maintaining financial stability, especially during uncertain economic conditions. Gold has been recognized as a store of value for thousands of years. Unlike paper currency, gold does not rely directly on corporate earnings or government performance. Its value is rooted in scarcity, durability, and global acceptance. The key question is, how should beginners approach gold investment responsibly? Let's examine this clearly and systematically. Gold as a hedge against inflation. Inflation reduces purchasing power over time. As inflation rises, cash loses value. Gold historically acts as a hedge against inflation. When currencies weaken, gold prices often increase because investors move toward assets that preserve value. However, gold does not generate income like stocks or bonds. It does not produce dividends or interest. Its function is protection, not aggressive growth. Gold is a defensive asset designed to preserve wealth. Gold during economic uncertainty. In times of financial crisis, geopolitical tension, or market volatility, gold is widely considered a safe haven asset. When equity markets decline sharply, gold often remains more stable. This makes it useful for balancing portfolio risk. That said, gold is not risk-free. Prices fluctuate in the short term. Its strength lies in long-term value retention, not short-term speculation. Investors who treat gold as a quick profit vehicle misunderstand its purpose. Types of gold. Investment. There are several ways to invest in gold: physical gold, bars or coins; direct ownership with no counterparty risk but requires secure storage; digital or paper gold allows ownership without physical storage concerns; gold ETFs, traded like stocks and provide liquidity; gold mining stocks, offer exposure to gold prices but include business risks. Beginners should prioritize security, liquidity, and transparency when choosing an instrument. Proper allocation. A common mistake is over-allocating to gold due to fear. Financial professionals generally suggest allocating 5% to 15% of a portfolio to gold, depending on risk tolerance and economic conditions. Gold should complement other assets such as stocks, bonds, and cash. Diversification reduces overall volatility. Excessive allocation to gold may limit growth potential because it does not compound like productive investments. Balance remains essential. Long-term perspective. Gold investment requires patience. Short-term trading increases speculation risk. Gold performs best when held as a long-term hedge, particularly during inflationary periods or systemic instability. During strong economic growth and rising interest rates, gold may underperform compared to equities. Understanding economic cycles is important before investing. Risks and considerations. Gold carries certain risks: short-term price volatility, no passive income generation, storage costs for physical gold, opportunity cost compared to higher growth assets. Gold should not replace an emergency fund. It is not a substitute for diversified investments. It is a stabilizing component within a broader financial framework. In conclusion, gold investment plays a strategic role in protecting purchasing power and strengthening financial resilience during uncertain economic conditions. Its purpose is preservation, not rapid wealth accumulation. When allocated wisely and proportionally, gold enhances portfolio stability. Economic strength is built through discipline, diversification, and risk management. If you found this discussion valuable, make sure to like this video, subscribe to the channel, and turn on notifications so you do not miss future content on investment strategies and financial stability. Thank you for watching, and I will see you in the next video.